are very well seeing how the job market is off lately. There are layoffs happening, new opportunities are very far and few. In this context, having a stable monthly income is the need of the hour. Just imagine getting rupees 50,000 to rupees 60,000 every single month without any stress, whether you are working or not. Life would be sorted now. But when we talk about passive income, people start thinking this must involve a lot of risk. But guess what? Even in 2025 to 26, you can earn this without taking any huge risk. In today's video, I am going to tell you about 6 such investment plans that will give you a steady monthly income. The very first option here is the Senior Citizen Savings Scheme SCSS. This scheme is 100% government backed, which means zero risk. In this scheme, you can invest a maximum of rupees 30 lakhs and currently you will get an interest of 8.2%. You can invest in this for 5 years but it can be extended by another 3 years, so a total of 8 years. You receive the interest every quarter and this interest rate can be revised by the government every 3 months. First, let's see how much monthly income you can earn from this scheme. Now, this scheme is specifically for individuals above 60 and the max investment limit is rupees 30 lakhs per person. So if there is a 60 plus couple, they can invest a total of rupees 60 lakhs in it. If you invest rupees 30 lakhs, you can earn an interest of rupees 61,500 per quarter. That means rupees 20,500 per month. So if a couple invests rupees 30 lakhs each, they can earn a total of rupees 41,000 per month completely risk-free. There is one more benefit of investing in SCSS. You also get a tax deduction of up to rupees 1.5 lakh under Section 80C. A very similar scheme is Pradhan Mantri Vaya Vandana Yojana PMVVY. This is also a senior citizen focused scheme. It is operated by LIC and the government guarantees the returns. So zero tension about safety. You can invest anywhere from rupees 1000 up to rupees 15 lakhs in it. The current interest rate is 7.4% annually and the best part, you can choose a monthly pension option. This means if you invest rupees 15 lakhs, you will get approximately rupees 9,250 every month. The term for this is 10 years, after which your original investment is returned to you. If it is a couple and both invest rupees 15 lakhs each, a total of rupees 18,500 per month can come into your account guaranteed for the next 10 years. Special thing here is that there is no market linkage. The pension is fixed and you get your money back after maturity, unlike an annuity where the principal amount can get dissolved. But yes, unlike the previous scheme, you don't get any ATC tax benefit here. And one more catch, liquidity is low. It can be tough to withdraw money in between unless there are special conditions. Still, if you want a fixed monthly income after retirement, this could be one of the good and safe option out there. So this was about senior citizens who have a corpus amount and are looking to generate income from it. We completely understand that very few people have such a large corpus. For those who do not have that much amount to invest, they can consider this next option, which is the Bank Annuity Scheme. With an annuity scheme, you can generate an income of nearly rupees 70,000 from a corpus of just rupees 35 lakhs. And yes, annuity schemes are also completely risk-free. First, let's see how much you can realistically earn from an annuity. And we have taken this calculator from SBI's website, so data is 100% correct. According to this calculator, if you invest a rupees 35 lakh corpus initially at an 8% return rate, you will get approx rupees 8.1 lakh every year, which is roughly rupees 68,000 per month. Now you must be thinking that in the first scheme you had to invest rupees 60 lakhs. But here you are getting more income from just rupees 35 lakhs. So what is different about this scheme? See, in the first schemes, you were only getting the interest as monthly income. But in an annuity, you get the interest plus a part of your principal back every month. So at the end of the first two schemes, you get your corpus back. In an annuity scheme, you do not get it back. That same corpus is divided and paid back to you every month. That's why the monthly amount is so high. Anyhow, let's look at the next way of creating a monthly income. Now, in this method, you will have to take a little risk. This is not completely risk-free. This is called SWP or Systematic Withdrawal Plans. An SWP is a way to invest in mutual funds. With an SWP, you can invest a lump sum amount and withdraw a fixed amount every month for a particular duration. With an SWP, because your money is ultimately in mutual funds, the risk is definitely much higher than the previous options. But along with that, the returns are also generally a bit higher. You should understand that with an SWP, you get both the returns and a part of your investment back every month. In an SWP, you can expect returns of 10 to 12% over a 7 to 10 year duration. Now, let's say you have rupees 40 lakhs and you want to generate a monthly income of rupees 70,000 from it. We will assume an average of 11% returns. So, according to this calculator, if you have rupees 40 lakhs, you can easily withdraw rupees 68,000 every month for 7 years, provided your portfolio grows at a minimum of 11%. This is the power of an SWP. As you can see, you get even more income here than in an annuity. But remember, the risk in this option is also higher. Before investing, you have to remember that your returns can even be negative, especially in a short tenure of 7 to 8 years. If you invest in an SWP for a longer time, say 15 plus years, then the probability of getting good returns increase significantly. How to invest in an SWP? We can definitely help you plan your SWPs. You can just click the link in the description and book a free call. Our advisors can help you sort everything. The next option is long term government bonds. This is a very underrated scheme. Basically, you lend money to the government of India for 5, 10, 20, or even 40 years, and they pay you interest every 6 months or sometimes monthly. The interest rate depends on the bond's tenure, but currently bonds are available for around 7.2% to 7.5%. If you invest rupees 20 lakhs in a bond paying 7.4%, you will get approx rupees 1 lakh 23,000 per year, which is around rupees 10,000 to 12,000 per month. Now, this is a less flexible option because bonds are locked in for the long term, so the liquidity is quite low. You can't withdraw the money in between unless you sell the bond in the secondary market. This is suitable for people who are planning for the long term and want a safe regular income. Talking about safety, our next option is everyone's favorite, FD, fixed deposit. At this point, nobody has any doubt about the safety of an FD. It is a time tested product and we highly recommend keeping at least 10 to 15% of your portfolio in FDs. And these days, the interest rates on FDs are so good that it makes a lot of sense to book an FD for 3 to 4 years. If you are tracking the RBI, you would know that it has been cutting the repo rate. This means that very soon banks will also reduce their FD rates. There is a strong possibility the RBI will cut rates even more in the next 3 to 5 months. So there is a very high probability that FD rates will fall in the future. If you are thinking of getting an FD, now may be a very good time to book FDs at these higher rates. In most banks, you get your FD interest quarterly, but in some banks like IDFC, you can also get monthly interest. And if you get a 5-year tax saving FD, you also get a deduction under Section 80C. In small finance banks, you can currently get 8.5% to 9% interest. Even in these banks, FDs up to rupees 5 lakhs are completely safe as they are 100% insured by DICGC, which is a part of the RBI. Related to this, there is one more option, corporate deposits. Now, this falls into a slightly risky zone, but it can give higher returns than FDs. Reputed NBFCs like Bajaj Finance, HDFC Limited, and Shriram Finance are currently offering up to 9% interest, and Bajaj Finance is AAA rated, so its safety is quite good. If you invest rupees 10 lakhs, you can get rupees 75,000 to rupees 90,000 per year in interest. That is rupees 6,000 to rupees 7,500 per month. Although this is relatively safe, it's obviously not as safe as a bank FD as it is not covered by DICGC. Therefore, invest only in high rated NBFC. Which brings us to our last and final option, monthly income plans, MIPs. MIPs are mutual funds that invest 70 to 85% in debt, safe bonds, and 15 to 30% in equity. The idea is that you get a regular dividend, but the dividend is only paid when the fund is in profit. Returns generally fall between 7 to 10% annually, so you get a little conservative equity exposure with regular payouts. You get two options, growth plan for long term wealth creation, dividend plan for monthly or quarterly payout. MIPs are best for those who want a balance, a little bit of growth, a little bit of safety. But it is not guaranteed, and sometimes the dividend can be missed. So go for MIPs only if you are okay with some ups and downs. So that's it. If you like this breakdown, please leave a comment on the video and share this video with your parents. It could be useful for their retirement planning. If you want help with your investment and are looking to connect with trusted advisors, you can click the link in the description. We are AMFL registered and regulated by SEBI. We are already working with more than 200 customers and managing a portfolio of 50 plus crores. So what are you waiting for? Click the link in description and get your investment sorted.